Hey finance virtuosos! Today we're diving into the world of investing for beginners. It can seem overwhelming at first, but don't worry, we're going to break it down step by step. So you've saved up some money, and you're thinking, what now? Maybe it's not enough for a house yet, but you know you should probably do something with it besides letting it sit in a savings account. Well, you're in the right place. This is the Finance Virtuoso channel. If you're new here, hit subscribe and the notification bell for the best money tips and tricks. Let's start with the basics. What exactly is investing? Simply put, investing is putting your money to work for you. The goal is for your money to grow over time, ideally at a rate that outpaces inflation. Because here's the thing, if your money is just sitting around, it's actually losing value due to inflation. That $1,000 you have today won't buy as much in 5 or 10 years. Okay, but there are so many options. Stocks, bonds, real estate, crypto, how do I choose? It's true, there are tons of investment options out there. And if you've spent any time on YouTube, you've probably seen ads from self-proclaimed gurus, promising to teach you how to get rich quick through day trading or Forex. But here's a word of caution. If it sounds too good to be true, it probably is. For most beginners, the best place to start is with a simple, low-cost index fund that tracks a broad market index like the S&P 500. Why? Well, as the legendary investor Warren Buffett puts it, by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. Let's break that down a bit. An index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to track the performance of a specific market index. The S&P 500, for example, includes 500 of the largest U.S. companies. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all 500 of those companies. The beauty of this approach is that you don't need to be an expert in analyzing individual stocks. You're not trying to pick winners and losers, you're betting on the overall growth of the U.S. economy. And historically, over long periods, that's been a pretty good bet. Now, I know what some of you might be thinking. But what if I lose all my money? It's a valid concern, and it's important to understand the risks. The stock market does go up and down, sometimes dramatically. In 2008, during the financial crisis, the S&P 500 dropped by about 38%. That's a big drop. But here's the key, investing is a long-term game. If you had invested right before that crash and held on, you would have recovered your losses by 2012, and you'd be way ahead today. The key is to not panic and sell when the market drops. Remember, you only actually lose money if you sell for less than you bought for. This brings us to an important point: only invest money you won't need in the short term. A good rule of thumb is to have an emergency fund covering 3 to 6 months of expenses before you start investing. And even then, any money you might need in the next 5 years or so probably shouldn't be in the stock market. So how do you actually start investing? Well, these days it's pretty easy. There are lots of online platforms that allow you to open an account and start investing with as little as $5 or $10. Some popular options include Vanguard, Fidelity, and Charles Schwab. These companies offer low-cost index funds that you can buy directly through their platforms. One thing to keep in mind, fees matter a lot in investing. Even small differences in fees can add up to big differences in your returns over time. That's why low-cost index funds are often recommended for beginners. They typically have much lower fees than actively managed funds. Now, let's talk about a concept that Einstein supposedly called the eighth wonder of the world: compound interest. This is the magic that makes investing so powerful over time. Here's how it works. Let's say you invest $1,000 and it earns a 7% return in a year. Now you have $1,070. The next year, you're earning returns not just on your original $1,000, but on that extra $70 too. Over time, this effect snowballs, and your money can grow exponentially. This is why starting to invest early is so powerful. Even small amounts invested regularly can grow to substantial sums over decades. For example, if you invested $200 a month starting at age 25, assuming an average annual return of 7%, by the time you're 65 you'd have over $500,000. Start at 35 instead, and you'd have less than half that amount. Of course, investing in index funds isn't the only way to build wealth. Some people prefer a more active approach, like picking individual stocks or investing in real estate. And there's nothing wrong with that, if you're willing to put in the time to learn and research. But for most people, especially beginners, a simple index fund strategy is a great place to start. One more thing I want to touch on, the idea of fast lane investing. This isn't about get-rich-quick schemes or risky bets. It's about investing in yourself and your own earning potential. For example, spending money on education or training that can increase your income, or investing in starting your own business. These types of investments can potentially offer much higher returns than the stock market, but they also come with more risk and require more effort. Remember, there's no one-size-fits-all approach to investing. The best strategy for you will depend on your financial situation, your goals, and your risk tolerance. And it's okay to start small. Even if you can only invest $20 a month right now, that's a great start. The most important thing is to get started and to keep learning. Before we wrap up, let's recap the key points. 1. Investing is about putting your money to work to combat inflation and grow wealth over time. 2. For most beginners, low-cost index funds are a great place to start. 3. Investing involves risk, but historically, the stock market has grown over long periods. 4. Only invest money you won't need in the short term. 5. Fees matter, look for low-cost investment options. 6. The power of compound interest means starting early can make a huge difference. 7. Consider fast lane investing by investing in your own skills and earning potential. Remember, this is just a starting point. There's always more to learn about investing, and it's important to do your own research and maybe even consult with a financial advisor before making any big financial decisions. I hope this guide has been helpful in demystifying investing a bit. If you have any questions, drop them in the comments below. And if you found this video useful, don't forget to like and subscribe for more financial tips and tricks. Thanks for watching, and happy investing.